All right, hi guys. I wanted to do this is an important video. If you're new, you should definitely watch today's market measure. Today is the 27th of January. It's really important because it talks about carrying the super trader style, and it goes into the math on why it works. Okay, now just so as a recap, Karen, and I'll post a video right here, but just for a recap, Karen, the super trader, she usually trades, if you watch her videos, 90, almost 2 standard deviations out of the money puts, and about 1 standard deviation out of the money calls. So the market measure I want you folks to really watch today, and it's under it'll be under here. It'll go to the most applicable market measures, and I've already posted it. So here's the 3 you want to watch: is what is undefined, which is today. All right. Yesterday's one, optimizing spreads, because a lot of you are going to be doing spreads and not going to be trading naked in the beginning. And then finally, watch this one, efficiency defined risk, September 17th. Yesterday's video, I went over those other two, so I'm not going to cover those again. But today's one was really cool. All right, basically, what is undefined, and it goes into real quick, and you guys can watch the slide. The bottom line is it goes into what the brokerage house determines as undefined, meaning where they think risk lies, and where that line is, so they know if they're willing to loan money on, meaning give margin, and where they think their risk lies. Because if a client can't cover their bet, the brokerage firm has to do it. So where's their risk line? Okay. So the general rule is that undefined risk strategies are based on a 2 standard deviation movement in the other line. Okay, so you can watch this video, but basically remember now, Karen sells a 2 standard deviation out of the money put. Okay, so look, this is on the SPX, exactly what Karen the Super Trader does. Now they're doing a 2 standard deviation strangles from 2008 to present. Here are the stats, and here's why she makes so much money. 83 out of 84 wins, and this is holding to expiration now, no management. 98.8% win rate. Now, the expected win rate was only 95.45%. Okay, so the expected win rate was this, and here's what they actually got. Okay, so here's where they talked about the risk, where broken firms are willing to loan traders money against the risk of outliers, because basically the firm is betting that anything farther than a 2 standard deviation won't happen. Okay, so you can go into it right here. Okay, and you can watch it, but look at the slides, right? Here are the 2 standard deviation moves expected versus what actually happened. So look, 45 days to expiration, there were 6,285 times that happened. Expected occurrences outside the range, only 5%. Actual occurrences that happened outside this range, less than 1%. The average expected move was 14.01%. The average actual move was 4.06%. So remember now, a strangle is they're betting that the stock will stay within the 2 standard deviation range. What does that mean? C and DO. Here's SPY. I can even change this to SPX if you want. All right. So basically, what they're saying is, and I'll even do a strategy right here. Come on, load. Let's go, guys, load. I'll go to strangle so you can see what they're doing. And 45 days separation, 2 standard deviations away. I'll click on that real quick and hit go. All right. Oh, come on. Why isn't it working now? It was working just like a few seconds ago. Whatever. I'll just use this. Here's 2 standard deviations away. 95%. This is 2 standard deviations away. All right. So in this case, in 45 days, right, they're expecting, I don't know why it's not showing. This is really irritating me. Show curve, right? Yeah, I want to show it. I don't know why it's not doing it. Oh, anyway. So what they're saying, does that help? No. Anyway, so what they're saying in 45 days expiration, what this means right here, what this means right here, 2 standard deviation, right? All they mean is they're betting that the SPY will stay in between these ranges on each side. So look, you're betting that within these 45 days, the SPX will stay above 1820 okay, and below 22.75. And for that, you're collecting $8.93 per contract, or $893 per contract. All right. So, what are your chances of being right? Well, can't really show you here because freaking dough is broken. So I don't know what the hell happened. So, but you have a huge. Your profit is huge. Okay, I don't know why. Let's do SPY then. Here, look at this. My bad. So you guys can see. Go. Here it is, and I'll zoom in. Here you go. In the SPY, which is, look, see this 2 standard deviation line right here? Here's the 1. Here's the 2. Your chance of being right is 97%, and you wonder why Karen sells them all the time. So you should watch these. So if you're beginning, listen up, because all we're saying is you can bet, you can make this bet, collect 46 cents per contract, or you can make $46 per contract. All a golden gecko is, the only difference between this and a golden gecko is you're doing 1 standard deviation away, and to cap your downside, because this one you have unlimited risk. If you're worried about the downside, all a golden gecko is you're selling the 1 standard deviation line in, so you're bringing these in, and your range is smaller, but you can collect more. All right. So if you're new, here's what you're going to be doing. You're going to do an iron condor. You're going to do, which is a golden gecko. You can do 56 if you want, but it's 45 is what they did their study on. You're going to do 1 standard deviation away, and you're going to do 5 strikes wide. You'll know why if you watch yesterday's video. So here's what it looks like. Okay. Here's what you want to get as close to this 1 line so you can move it a little bit. Oh, that's it. There's nothing left. You know why the strikes? Let's go like that, and then I can move this out like this. Okay, and I want to make the strikes 5 wide apart. So with this mid, see this 1 standard deviation line right here? For you new beginners, you're betting that SPX or the S&P 500 will stay in this range, the green range. You make money. Anything outside of that, you lose money. And for the strikes wide, you want them 5 strikes wide apart. So I'm going to click this, and I'm going to move these out till this says 5. See, 5 strikes wide. This side, 1 more out, 5 strikes wide. There you go. 84%, 1 standard deviation away. You're buying the wings as protection. 5 strikes wide, which if you watch yesterday's video will show that's the most efficient as far as return on capital. If you have less capital, your profit is 69%. You're going to collect 67 cents per contract, or the most you can make is $67 per contract. The most you can risk, the most you can lose is $432. So look at that. 10% of this is $43, right? So look at your return on capital or return on risk. Way better than 10% in what, 45 days or whatever, right? Or 50, I don't know, 52 days. Okay, and your chances of being right are really good. Now you can go wider if you want to do what today's market measure says. You see these strikes or strikes, you can move them out. I'm sorry, see the widths, you can move them out. Watch. See the arrows pointing out? I'll just trade it like this. And you can crank it all out in dough until until this hits to 95%, right? The 2 standard deviation line. Okay, right around here, you can even push it out a little bit. Okay, and look, your profit is 95%, but then you collect a lot less. All right, so that's why I was saying this market measure is really, really important. This is what Karen the Supertrader does. All right, so what she does is, and if you're looking at and I tried to make this lighter so you could see, here's the SPY. See these blue lines? Those are the 2 standard deviation away Bollinger Bands. So when IV is above 50, as you can see, it's climbing because today was a down day. But when IB is high like this, okay, she's betting the 2 standard deviation away puts. So what does that mean over here? When the market, I'll clear this. When the market is down, like today's a great day. I mean, she prefers it over than 50. But I'm just telling you guys, you're gonna do this when the IV rank is up. When this number right here, IV rank is 50 or greater. The higher, the better is when you want to put your positions on. In Thinkorswim, you can see this here in the studies here, and you can see it's at 45. You want to trade it when it's above that green line, above 50. And all she does is, real quick, when the stock market is down, like today, she'll sell a put, right? And she'll do it 45 days away. And what I'm looking for is, okay, wait, I'll clear this real quick. And I'll move the, wait, how do I clear this? So just so you know how to read this, You're just doing an, well, I'll just click on this. All right. Look over here. Here's the time. Here's the days expiration. So she does close to 45 days you can. See this 52? So that's this line right here, right? So all you do is you're going to put a put right around the one standard. She does all the way out here. See, look, that's what she sells. So today on a down day, right? So the market went down today, right? $2.71 down on a down day. It's going this way, and so she's betting it'll stay higher. She's making a bullish bet that it'll stay above 174. Because it's on a down day and she's betting opposite the way the market is going, she can collect more money. You can collect more money. See that? Now, and she sells it. And what happens is she waits. If the market goes up in the next 2 days, 3 days, and she makes money, she'll take off the position. If the position moves against her and somewhere down the line it looks like this, from 98, she keeps them on until she sees this. Until this shows 70, then she'll roll it. Okay, she'll roll it to maybe a further, like the next week out or 2 weeks out, and but then when she puts on a new position, she'll put it at maybe 84%, which is one standard deviation away. Okay, so she doesn't wait till she gets into trouble. She manages her positions before she gets into trouble. All right, that's how she does it. Now, remember, if you look at, so I hope that helps. But that's why I wanted to go over today's market measure. All right, watch those. Get today's market measure, yesterday's one, and that September 17th one. Now, real quick to the charts. Remember, if you look at maybe a couple videos back I made over the weekend, we talked about how to trade earnings, or just so I could show you how to sell a put. Look at Apple. All right. Is this Apple? Oh, why isn't it changing? Was it AAPL maybe? Yeah, there we go. Here's Apple. I've got like 3 minutes left. I try to do 15 minutes, 7. Okay, so here's earnings, right? Earnings came out today, right? After the market. As you can see here, it was a $2.58 estimate. They beat it by 306. All right, IV rank. See how IV rank was high, 92% today? And remember what I told you? You don't know which way it's going to go, but I can guarantee you that IV rank will drop after earnings. So remember, if you're beginning, you would want to sell a 1 standard deviation put or a put, betting it'll go higher because you're thinking if you were bullish on Apple. So remember, I'll show you on the chart what it would look like. Go to Apple, right? In your settings under strategies, you would have clicked on vertical. Your short put is the default. And you would have it 1 standard deviation away, 5 strikes wide, right? Now, because you're doing an earnings, you don't want to wait for 52 days. You want to do it sooner. So you would move your expiration by doing this to maybe I think the first week in February earnings. Or you could have done January too, because the earnings came out today, right? So check it out. Here it is. And then you would just move your strikes. Here we go. Move your strikes on Apple, right? If you're bullish, you'd want to be, maybe 84% out of the money, right? So I'll move the strikes. This is 84%, okay? And then you want your strikes to be 5 wide. So you would go like this, right? This is the basic trade I want you all beginners to learn first. And you can toggle from here, see? So you're 84%. That means you have an 84% chance of success. You would have collected probably more because this is after hours. $1.19 credit. So you would sell the 105 put. So you're betting, oh, earnings comes out. I think it's going to go higher. Let's bet this. You have an 87% chance of being right. You're betting Apple will stay above $105. And what you're also betting on is right after earnings, IV rank collapses. And then you make money when this happens, and you want to make money in direction. Okay, now look at what happened after hours. I'm going to switch this to the 15-minute chart. Okay, this is the 15-minute chart. So here's where Apple closed today, right? Earnings came out, and look what happened. Unbelievable, right? And I guarantee you IV drops. So, but remember now, look, right now, Apple after hours is trading at 115. Remember on Dole, you're betting it'll stay above what? 105. So this would have been a winning trade for you, especially after you want to continue to go higher and you want IV rank, and you can close this trade, buy it back to close it on the open. Okay? So that's why I want you folks to learn that first. I hope this helps. Any questions, give me a shout out and let me know. I'm glad to help. Good night.